Okay, wonderful. Hi, everyone. I know we're the only ones standing between you and lunch, so we're going to make this punchy. This is going to be an exciting panel, so I hope you guys enjoy. For those of you who don't know me, my name is Charlene Chen. I'm probably better known for being a co-founder and COO of Ezrah Finance, which in the early days was called BitPesa. This is a topic that I'm really passionate about because we were using crypto and blockchain technology to significantly lower the cost of remittances. But let's get into it. We have an amazing panel here today. And instead of doing kind of standard, boring introductions, I'd love to kick it off with having each of you introduce yourselves, define your role, the mandate of your organization, and then define what underserved means to you in terms of who you're serving. Okay, why don't we go down the line? Thanks, Victor.
How do I go? Oh, thank you. So good afternoon, everyone. My name is Victor Ndlovu. So I represent Mastercard, East Africa. So I've been with Mastercard for just under 2 years. My role there is actually to digitize payments, to displace cash, and more importantly, how do we get more and more people financially included? In terms of my background, before I joined Mastercard, I spent a bit of time with a fintech in South Africa called Ukwuani. Learned a lot in a very short space of time in that fintech world. And then prior to that, spent 12 years with Visa, in East Africa and in South Africa, and then 17 years in my home country of Zimbabwe working for 2 banks, Standard Chartered Bank and Commercial Bank of Zimbabwe. So extremely excited to be here and looking forward to the conversation. Thank you.
Welcome. Go ahead.
Okay. Good morning, everyone. My name is Omondi Ochieng. I'm with Moneypoint. Moneypoint is, in a very simple way, a full-service bank, primarily for businesses. And what we try to do is to provide businesses with a seamless and a very coherent platform where they can do all their payments. We can provide them with credits. We can then layer on solutions like business management tools on top of that. And ultimately, they will not really need to leave that platform to do anything from a financial perspective. My background is split into two parts. The first part is the professional training, which I did with Delight, but then I quickly realized that there's a lot more impact on the startup side. So I spent time working in an operational role with 2 fintechs, one in the payment space, one in the credit space prior to Moniepoint. I also spent time working in venture capital before joining Moniepoint close to 2 years ago.
Great, thank you. Wayne?
Thanks. Wayne Hennessy-Barrett. I'm founder CEO of 4G Capital. We are a digital lender that provides working capital blended with enterprise training to self-employed, informal market traders in Kenya and Uganda. I'm very proud to be sponsoring this event. This is our 10th anniversary, and it's tremendous to see the progress that's been made in the industry. Our clients are the low-income, self-employed mama mboga in Swahili, so the ladies who sell your fruit and vegetables. They are the gentlemen who will sell household goods and fast-moving consumer goods, the mom-and-pop shops that are moving really good brands, local brands and international brands, through the small duka shops that stud every road and community across Africa. They will often be extremely profitable, but with very small amounts of money in circulation, so fast-moving, and they will lack the financial liquidity, they'll lack the individual cash reserves to be able to buy the inventory and the goods that they need to sell so that their business can grow. So they're very vibrant businesses. They're an incredible investment opportunity, and it's our privilege to serve them. But by underserved, not only is it that absence of liquidity to be able to organically grow, but only about 50% of them actually have formal bank accounts. They will be off the grid compared to more developed markets where registration with government services, registration with the taxman, access to pensions, access to state education, access to state health. This is what is meant by underserved. And so what we're trying to do is help this amazing segment, this huge and growing segment, on the pathway to formality, from an informal life of survival to a formal existence of thriving, of contributing and benefiting from an integrated economy.
Great, thanks, Wayne. Jackie.
Yes. Hi. So my name is Jacqueline Aby. I'm founder and CEO of Magma Tech, which is a Pan-African money transfer and aggregator solution based in Abidjan, Ivory Coast. We have 7 subsidiaries across the West Africa Francophone countries, and we operate in 14. So we have payment rails to mobile money, bank account, cash pickups, and some bill payments across these 14 countries. That's essentially what we do. Underserved for us is a lot of things. I'm underserved, I believe, in Ivory Coast. So it depends on what your needs are. So we're trying to address both the really underserved who maybe don't have banking but have access to other financial solutions, and also people like me and you. What is underserved? Can you send a bank transfer? Like, for instance, you can in Nigeria instantly. We cannot do that in our region. So we're trying to build an infrastructure to make, for both businesses and individuals, easier access, actually, to financial products.
Great, thanks, Jackie. Obi.
Hi, good afternoon, everyone. My name is Obinna. I'm the Chief Digital Officer at Bank of Kigali, Rwanda's largest commercial bank, with over 50% share of profits in the market, nearly 50% share of net loans. I lead a division called the Digital Factory, where we are, driving the transition of a traditional financial institution into a more agile, technology-driven commercial organization. We're building the company's, or the nation's, most competent suite of digital banking solutions, and we are engineers, we're product managers, or product designers. We are a modern technology team, kind of in the middle of what is otherwise a very traditional organization. Underserved to us, I think, is anyone who doesn't have access to the full suite of financial services that exist in the market for whatever reason, whether it's distribution channels, remoteness. That's what we consider underserved. And since the bank's inception in 1966, we've been really focused on reaching every single person in the country.
Great, thank you. So we have this amazing panel, but you guys have described what you do now, but some of you have had depth of experience in financial inclusion. So to kick it off, we want to talk about what's the impact that we're actually trying to make, and what are the keys to success to making it. So I'd love for a couple of you guys to talk about the most impactful, and I know impact can be defined a lot of different ways, but the most impactful product or service you've ever offered, either now or in your previous career. What was the problem you were trying to solve, and what were the keys to success? So why don't we kick it off with Wayne?
Thanks, Charlene. That's really kind. This sounds really a little bit smug and self-serving, but
you can be smug.
It's what gets me out of bed in the morning with a spring into press up straight away. It's why I love my job so much. It's why I love my team so much. It's why I love my customers so much. What we're currently doing is the most impactful thing I've encountered. And we've been doing it for 10 years, and we've been getting better at it, and we've been iterating it. But the power of a short duration loan that is designed and delivered on the terms that work for the customer, that is priced according to their risk, but also within their business margins, so that between their buyout and sellout point, they will always be up at the end of a business cycle. And then loading that in with the business training that gives them the knowledge to run a better business, keep better records, budget, plan, forecast. And so we pay very, very close attention to the data and to the continuous feedback we have from our clients. So we have continuous messaging, continuous surveys, and our customers' voice is what we follow. And so we know with great assurance from that our clients will grow their revenues over the course of a year by an average of 82%, an average. That's nuts. I mean, that's amazing. 97% report that they've increased their financial literacy since becoming our customers. 65% of them have employed other people after being our customers. So they're creating jobs. We're helping them to create jobs. I was the first branch manager in a little village called Wangigi, just to the northwest of Nairobi in 2013, with my not very good Swahili, with a Nokia feature phone giving M-Pesa loans. And 10 years later, we have 1,000 employees. We're Africa's highest scoring B corporation for a Fintech. And we're doing something that the customers really, really need. I've seen it go wrong before in my career working as an employee. Beforehand, the company I was with, really well-intentioned, so no criticism at all, but they really wanted to go heavy on credit cards. They wanted to give prepaid cards, and they handed them out like candy. And they didn't have a repayment or a collection mechanism in place before this happened. They didn't really have any control or line of sight as to how that money would be used. And we know that there's an enormous appetite for consumer credit as well as for working capital. And so that wasn't my product, but it was the company I was part of, and I wanted to see it succeed, but it did not. So I think the importance of client-centric design is what keeps you on the straight and narrow.
I love it. And just to probe a little bit further, so yes, you just mentioned client-centric approach. You also mentioned data, right? That's obviously key to any lending service. But what were other keys to success? I'm going to put a plug as a career COO. You got to have a great team. You got to have smooth operations. You got to have great systems and processes. What were some of the key success factors from an operational perspective?
Yeah, sure. So you need a really good team. You need people who are really, really good at their jobs. And that is something that we've learned along the way. And just really for brother and sister, entrepreneurs, people who are beginning or startup journey, just be ruthlessly professional from the beginning. Don't play, we'll find out what happens. By all means, experiment. By all means, A/B test. But get people who are good at their jobs. Have clear processes and policies and frameworks. That provides the mechanism for reward and to grow your talent, and accountability, so you can identify when somebody is struggling and help them with extra training. But ultimately, if you've got people who are bad apples in your business, they're going to damage your customers, they're going to damage your brand, and they won't be happy inside, because they won't be succeeding. If they're committing fraud or up to all kinds of bad behaviors, they're actually killing their souls one day at a time. And so the best thing you can do is help them go somewhere where they'll find the right place for themselves. And that's not always easy, but it's absolutely necessary.
Great, thanks, Wayne. Obi, would you like to share the most impactful product you've ever worked on, especially at a bank you've probably worked with a lot, and you worked previously with other fintechs?
Yeah, the country, the bank, we've made several attempts at including the unincluded. I think one of the bank's most famous attempts was Ikofi, which stands for, I believe, wallets in Kinyarwanda. I might be wrong. But the idea was to capture the roughly 4 million farmers around the country who didn't really have access to financial services, or most of them. Rwanda as a nation is financially included up until, I think, 95% now. This is a blend between banking and mostly mobile money, quite frankly. And of the adult population, roughly 40% is bank. So we're trying to close that gap. One of the challenges that we saw was customers or farmers, the farmer customer base using Momo. When you're making $300 to $500 a year selling corn or coffee or tea, that 5 to 10% tariff that the telcos take is a lot of money. So they're extremely inelastic when it comes to those fees. And we tried to compete with a solution that was zero-based. Some of the things that we found as challenges, vendor selection, go-to-market strategy, ultimately learned quite a bit. And also penetration of phones, right? So we moved from Ikofi. Now we're looking at smartphone financing. Last year, we worked with MTN and another third-party vendor to launch the country's first smartphone financing scheme. And that product since November has grown about 100% month over month. And with smartphone penetration in Rwanda at only 20%, with roughly 10.5 million subscribers overall, we see an opportunity for loan portfolio as big, if not bigger, than the bank's current loan portfolio. You're talking about millions, several millions of smartphones that are yet to get into the hands of customers, and so far we've seen really good uptake. So I think it's probably one of the more successful attempts we've had at financial inclusion.
That's great. And what would you say were some of the critical success factors? I think you said the golden, I don't know what you call it, but like the golden cup, the golden ticket of all of us who are doing fintech is a partnership with a mobile network operator like MTN. Do you think that's a key to success, or is it more internal? Like, is it external or partnerships? Is it internal? What's the key?
Yeah, I mean, I think it depends on where you sit and what resources you have. As a bank, traditional institution, big, lumbering, but lots of resources. Obviously, the telcos have distribution that companies like ours could only dream about, right? So there's no accident that the most successful and the fastest success that we've had has come with that partnership. It is not impossible to compete, though, with the telcos and to have that kind of reach as well. I just think the bar is a lot higher. I think the bank is on track. As I said, we're building the nation's most competent suite of digital financial products. This is across the mobile app, agency banking, USSD, web, kind of a connected platform all the way across. So whatever your preferred flavor of accessing digital financial services, we can get to you. So banks can, but I think in the interim, most people are probably better off finding a really good telco to partner up with.
Great.
Yeah.
Okay, let's continue on with impact. So most companies in this space tend to focus on, say, access to finance or lowering transaction costs. So we tend to talk about this space like quite transactionally, but there seems to be a lot of other short-term and long-term impacts that can also benefit our consumers. So I'd love to hear more about financial literacy, or kind of what are the longer-term asset accumulation. What are some of those things? Maybe we'll start with Victor.
Thank you. So I think I just want to start by talking a little bit about what Mastercard does in this space to serve the underserved. So as an organization, we came up with a project that said, we've got all these people that are underserved and underbanked, and so our target as an organization is to actually get 1 billion people to be financially included by 2025. So that's a mandate that we're chasing as an organization. We've already reached 500 million already in this space. But now if I then look at some of the problems that we're trying to solve for, so if I look at some of the things that we've done here in Kenya, for instance, we have a program that we call the microcredit program, which is really addressing that specific segment around, lack of access to capital, access to obviously data. I think when you mentioned data compilation, and obviously how does the technology come in and put everything together. And additionally, working with partners in this particular case. In this case, working with our financial institutions, which was KCB in this case, and Unilever, which is a FMCG in the space. So what we did is we have a team here in Nairobi of software engineers who really try and unpack a problem statement. And the problem statement that we're unpacking at the time was, how do we help these merchants who are really struggling to actually sell their commodities or even stock up their goods? How do we bring them all together? So we came up with a concept called Jazaduka. So Jazaduka is a product that we've actually rolled out here in Kenya with the two partners that I mentioned earlier. And what it does is we've identified, obviously, merchants that are in this segment that want to be able to participate economically and obviously improve their livelihood and obviously, the livelihood of the country, et cetera, et cetera. And out of this program, 20,000 merchants have benefited from this program. So the bank provides the credit, and then obviously from a stock perspective, Unilever comes in, and then we provide the technology using obviously mobile phones and all the various gadgets, for example, solutions around acceptance that will enable that transaction. So from the time that this product was launched about 3 or so years ago, we've actually grown phenomenally, which means it's really addressing the segment that we want to be able to address. So for example, in 2022, between January and December, we saw a growth of about 300% in terms of loans that were disbursed, growth of transactions, those particular customers now building a credit history around their transactions, and more importantly, going back to stock up whenever they actually ran out of stock. So there was never a time that they never were out of stock. And again, that starts to now build the momentum in those communities where these people are served. So for us, Jazaduka has been a success, and obviously we are thinking of rolling it out into other countries because the concept really works very well.
I love this example because it just shows how it's not about just alleviating access to finance or one transaction right now, but credit history. We're going to be talking more about credit later in the panel is just so important. And that's one of the challenges in the informal sector where if there's records, they're often on paper. So this idea of digitizing records and establishing a credit history that can enable you to access other financial services is, it's critical. Great. I think, Omondi, you had another example.
Yes. Probably if I take the same question around thinking about impact, but I also want to tie it to two things. I think one is the definition of underserved, but then also on the element of how we are thinking about product design and delivering the products. On the definition of what's underserved, I think it's primarily markets where either banks have decided it's not profitable to serve, so they're not designing the right solution for them. Because ultimately, as a fintech, we're not doing anything new. We're providing a payment solution, we're providing credit solutions, we're providing technology solutions. All those are things that are available in the market. So it's a question of how do you design for a market that is largely ignored by other players. And the way or the approach we took was the approach of going to the customers to listen to what their biggest points were. And specifically in the Nigerian market, those pain points were tied to reliability. Half of payments in Nigeria will fail, likely due to reliability issues. It can be reliability at the processor level, reliability at the bank level, or reliability at the switch level. And all this, the only way to solve it is to have a really good understanding of the infrastructure so that you can build what is necessary to solve for that. And the way Torsten and Felix did it, using their background in InterSwitch, was to rebuild an entire new processing layer. A processing layer which was more efficient, which allowed for dynamic routing of transactions, so that even as you pipe into multiple processors, you're able to proactively switch across that. Then, as payment fails, one of the big things that usually come up is chargebacks. So how do you create a product that can proactively address the issue of chargebacks? One way we've done it is through full transparency, because the full transparency creates a trust between the merchant and us as the provider. And the way we do it is by giving them a dashboard, which on a real-time basis, they're able to see how the uptime across various processing routes look like, how the uptime across various issuers look like, and it gives them power at the point a card transaction fails to indicate to the customer, this is what I think is the issue. If we wait for 5 minutes, I'll be able to resolve this. Or proactively, even before the customer uses their card, is to indicate to them, I think this will fail. So I think that's step one on the payment side. And as you build out the payments angle to this, you now get the necessary data flows. Because ultimately, the strongest and the most useful data in underwriting are payment flows. Because payment flows will show the ability to pay, and payment flows, if they're running on your own platform, gives you the opportunity to either directly debit, so that you don't come to a situation where you're forcing the merchant to think about paying you back. You give them a product that works for them, and you can take 1% of each payment that comes after you give them credit. So with that data, you're able to build a good credit scoring system, which allows you to lend the amount that they exactly need. You're not lending more than they need, you're lending what they need to grow their business. And on the basis of that, they don't also have to think about how much they need to repay you, because you have structured your payment or repayment patterns within their own cash flows. I think I'll talk about from those two perspectives, but I think broadly, there's a lot of work that needs to be done in those two areas to provide better experiences from the merchant and design better solutions to encourage access to finance.
Thanks for sharing that. I mean, infrastructure isn't always the sexiest thing to talk about, but if we're trying to reach the unbanked and the underserved, we need to have the right distribution channels and the right infrastructure, whether those are tech channels or a brick and mortar distribution network, in order to get, money where it needs to go. And that's a perfect segue to you, Jackie. I mean, a remittance doesn't exactly make impact if there's a failure point in InterSwitch or NIBS or GIPS or wherever it is. So love to hear about the impacts that you see in the remittances space.
Yeah, exactly. So infrastructure is the name of the game. You have to have, access to it. So what we're doing is we're building on top of existing telco distributors, post office, and through our network, we do agency banking. So you could have someone in the north of, let's say, Ivory Coast, where there would maybe only be one bank. In our network, you would have access to 2 or 3 banks, the banks that want to work with us. So just to jump quickly back to financial literacy, in our region, we have about 15% banked people of the population, whereas we have 137% mobile users. So mobile money is the first entry point to financial literacy. The first is getting used to not having your cash in your hand. So that's already a habit to get used to, and then try and get them over, not necessarily to a traditional bank, but some sort of solution where we have the traceability, where they can get used to, okay, I don't have to withdraw all my money in one go. So for a farmer who's paid every trimester a lump sum, they would usually go and just get out that lump sum and put it under their mattress. We're trying to show them you don't have to do that. You can just withdraw what you need and keep the rest. And then that would, with the partnerships we do with the bank, tie into, okay, you can actually, have credit or other products, financial products, such as health insurance and things like that, because you become solvable. You've always been solvable, but you had no way of proving it, that you were actually, as Wayne said, that you're generating revenue, you're employing people, you are a super entrepreneur, but it's not traced anywhere. So that's just for the financial literacy part.
I love it. And just to add on to that, the thing I love about remittances is like the opportunity for the recipient to decide how to spend that money, which often goes statistically to healthcare of the family, food security, maybe acquiring additional assets. So like remittances as a source of income from the diaspora can open up a lot of opportunities. Okay, so we have a lot more questions, so I'm going to speed it up a little bit, so let's get a bit more punchy. But before we move on to cost, I'm going to hand it to Obi. I think we need to talk more about failure as entrepreneurs and business people. Could you just share an example of a financial service or offering that had really good intentions, but for whatever reason just didn't create the impact it was designed to?
Yeah, so a few of those. I've mentioned one. That was, Kofi. I think all in, banks spent millions of dollars on that. It just didn't have the uptake that we were hoping for. And there have been so many discussions now about shuttering the project, and cutting our losses. And again, I think there was a distribution failure. There was an incentives failure. Like, why would you join this network if there's MTN and there's Airtel? The network effect did not exist. So you join as an Kofi user, you can't really send money to anyone else. The technology was a big challenge as well. This was one of the platforms that the bank did not build itself. I kind of inherited it. And I think if we would have had more control over the experience and maybe had more success. There's another product called BK Quick. So we were one of the pioneers in instant digital lending in the market. It was in 2018. And in the first few years, NPL was at 40%, something ridiculous, right? So initially, I think the way that we approached credit scoring wasn't very sophisticated. Over time, it improved. Now, BK Quick, now it's at 2 to 3% NPL per cohort. So now it's like a break-even product. So initially a failure, Now it's a promising thing that the board and the rest of the leaders are looking to double down on and hopefully make it a more prominent part of our portfolio. So some failure, some almost failure, always lessons learned. I think that's the most important thing. When you fail, you need to do a postmortem and figure out exactly what went wrong. Use those lessons and improve maybe what might have failed, or come up with brand new ideas that have a much bigger chance of success.
Well, thanks for having the courage to share about failures openly, and I encourage
Yes.
everyone to do that, because we're all trying to serve the underbanked and underserved, and if we don't share lessons learned, we're all
Yes.
going to repeat the same mistakes.
Yes.
Okay, so as a true ops person, I broke this down into a little bit of a P&L. So we're going to go into the cost side of things, and then we're going to cover revenue. So to kick it off, I mean, you guys have already mentioned some new technology, or relatively new technologies, thanks to more increased smartphone penetration. We have the beauty of mobile money, which now has hundreds of implementations beyond our amazing homegrown M-Pesa. But trust is a big thing when we're talking about money. And from my experience, a lot of people are still saying, okay, yeah, I have my cell phone, but I want to know where my money is sitting, even if it's digitized. Who can I go and complain to when my transaction fails? So, there's still the old school brick and mortar of, traditional agent banking. So I'd just love to hear, what are the main fixed and variable costs in your businesses? And maybe we can go to Omondi first.
Okay. I think I'll start by prefacing how we have structured our business generally. Because yes, we are running a fintech, but our distribution is primarily offline. And that is intentional, primarily due to, as you mentioned, the trust factor. The trust factor for financial services is a very critical piece of product design. And then it's a question of how then do you solve for that trust factor. And the way we have done it is by creating a distribution network which is driven off the back of hyperlocal salespeople. The advantage that gives us is twofold. On the cost side of things, as a salesman living in your own locality, the cost of customer acquisition is not that high, because these are your neighbors who are running businesses. You can talk to them, and if the product or the solution has a very strong value, they will buy it. So that limits two things: the trust factor, the conversion factor, and also the element of setting up a very expensive network. The other element is around thinking about costs, not just from the perspective of the cost that you will see, but looking at costs which are implicit. For example, in the agency banking space, the transaction fee is what people will see. You come, you transact a $100 payment, I charge you $1. It's very easy to look at that 1% and call it out as the cost of transaction. Or in the case of mobile money, in some markets, the charge can be as high as 10%. But if you flip that cost and look at it from the customer perspective, before mobile money was in place, this customer would have been forced to either travel to a bank branch, would have been forced to leave their day-to-day activities, spend 1 or 2 hours to go and access cash. But the convenience that technology brings then creates some savings for them, which are implicit. Because when you're traveling, you don't keep a record of all the receipts. Okay, I use this much in taxis, I use this much to eat at the market, I spent 2 or 3 hours at the bank branch. If I calculate what the cost of that 2 hours is, you don't accumulate those costs, but it's very easy to see the transaction costs. I think once you look at the implicit cost of the product, it's then very easy to figure out how to price it. And this, in my mind, also applies not just to things like payments, but also credits. But the implicit cost in credit will be what alternatives the business had previously. And those alternatives will be either to forgo growth, because you cannot access credit, you then grow at the pace of your profits. Or 2, to access credit, but in an unstructured manner, either from a Shylock, and if you don't repay that, they can come and break your legs. Or you get credit from a traditional bank, which does not care to understand the cash flow cycles of your business, which mean if you are in a low season, the bank is still expecting a fixed payment, but your business is not generating the same amount of cash flows. So I think understanding cost from the perspective of the customer and pricing it into the products is a very critical element.
Great, thanks so much, Omondi. Let's take it over to Jackie. One of the biggest pain points for, and I know this personally, for remittance companies is, the so wonderful liquidity management, right? You don't know exactly, I mean, you can try to predict as best you can, but you need to have all these local currencies and all these different countries. You know, how do you guys manage liquidity management? Are there other kind of costs that are baked in that people don't think about beyond the transaction costs that Omondi mentioned?
Yeah. We open bank accounts in all countries with all banks. So basically, because today we don't, as I just said earlier, we don't have any instant way of doing transfer into banking. And we need to be able to, because you cannot predict always, no matter how much data you have, no matter all the prediction models that you're using, you know, so we work a lot on pre-funding. A lot of our partners pre-fund us, and their needs can change from one day to the other, and you have to be able to address that instantly. And I think that's what makes our strengths as well. So our partners can pre-fund us into one account, and we will dispatch it across our different regions. So it's really good partnerships with our banks. So we have less charges, and we have something called frais de mouvement. It's not a normal bank fee. It's a fee on the money that you receive and that you send out and whatever crosses. And when you have a lot of money going in and out of your bank account, you don't want to be paying 0.2% or 0.04% on that money because you're just paying for the money. So it's really good partnerships with the banks and finding other ways, because the bank always has, everyone has to profit from whatever you do. So how can we work with the banks on other solutions or products together where they can make some money? So that's what we do for cash flow, essentially. For the trust, I just wanted to come back on that one. For the trust, so we're trying to build the trust with our distribution network. So with the big distributors, with the banks, with the post office, because they already know the customers. And so we work on a revenue sharing model. So we don't have a lot of fixed rates. We are startup first. We're in a year and a old half. How do you say it? 18 months old. So we're startup and we're fintech. And for us, we have to be very agile and quick on the feet, because one product might need, tweaking here or there. So we're putting most of our money into the development at the moment, development and support, and everything else goes to revenue sharing with the distribution networks who already knows the customers or end consumers.
Thanks for sharing that. I love this creative distribution channels, right? Like, it just doesn't make sense for every fintech to go around and try to build out a distribution network. So I'm a huge fan of the post office distribution network, and we've seen other fintechs do gas stations, petrol stations, which I think is, it's like, okay, this is a point that's everywhere, and granted, only certain sectors of society, or in the U.S. and more developed markets, people are leveraging grocery stores, and so just thinking like, where do people go and transact and trade, and then where can they do money there as well? So there's the famous/infamous like Walmart and I think it's Western Union partnership. Okay, so moving along to Wayne, we all know in this industry, debt don't come cheap. So for those of you who are doing lending, how do you manage this cost of capital when you're a lender yourself and you're trying to acquire more lending capital?
This is the Gordian knot of the industry. Credit is too expensive in emerging markets everywhere, but particularly here. And so you're in this ghastly situation where, certainly as a startup lender, you're trying to raise capital to grow your loan book. And regardless of all the good things that I described and how well we design our products, how well we look after our customers, how well we curate our culture and our team, we need to lend at a price that is sustainable so I can pay my employees, so we can develop our own technology, buy out existing technical debt, invest in modern engineering techniques so that we can evolve more structures and all the rest of it, and at the same time try to bring down the price for our customers because it is expensive. But at the macro level, you're looking at a central bank rate generally flickering around the 10% mark, just under. And so then if treasury bills, government bonds are going to be low to mid-teens, that's your start point. Because why on earth would anybody lend to an unsecured lender when you can lend to the government, get guaranteed repayments, and make 16% for going to bed and playing golf? So that's the base point, which you have to explain when you then talk to impact investors and venture debt fund providers and all the rest of it, who are generally sitting on hard currency.
Yep.
They won't have local currency. So then the foreign exchange risk is passed to you as the operator.
Exactly.
So we're talking about a managed 10% decline on the shilling, generally year on year, and sort of generally well-controlled inflation rate of 10 to 6% as well. So all this is my problem, which I'm trying to shield my customer from, and then explain to the impact investing community why my prices are so high. So it is a really, really tricky thing. There is a way ahead. There's a really good way ahead, which we have benefited from, which is where large institutional investors, DFIs, fantastic organizations like the American DFC, provide credit guarantee facilities for local banks to lend in local currency. And I'm referencing them because we benefited enormously from a $3 million loan, equivalent $3 million in Kenyan shillings, which was completely guaranteed by the DFC and the Ford Foundation. And we're paying 9% on the shilling for that. 9% on the Kenyan shilling. So the bank was taking no risk. We were able to keep lending to our wonderful customers throughout the COVID pandemic, and to the best of my knowledge, were one of the few, if not the only, digital lender that kept lending to businesses so they could trade through that awful, awful lockdown time, so they and their families could eat, and so they could serve the communities that were struggling through all of that. We dropped our prices by 10%. We got rid of all of our late payment and penalty fees, not just for the customers affected by COVID, but throughout our company history. We partnered with my great friend Ted and his company Charako, so we could provide medical insurance to our customers, which covered COVID, and we also used our distribution network to put out hand sanitizer, face masks, and we repurposed our business training to avoid infection and to do all the rest of it. So we did our jobs. We need to work together with DFIs, with local banks, to bring down the cost of credit, where we can tell our story more powerfully, because that price of credit is related to confidence and perceived risk. And I'm here to tell you that my customers are a jolly good bet, and so are companies like 4G Capital at getting liquidity into the marketplace. And so that's a kind of a call to arms, really, for institutional investors, to work with the fintechs, to work with the regulators, to try to make these financial products work for the customers, because they are too expensive.
Thanks, Wayne. Yeah, let's just hit this on the head. I can share personally, for the charitable trust that I'm running, we've been looking at affordable housing. And even with a refinancing mortgage bank here, KMRC, 26,000 people in Kenya have mortgages. So there's a huge gap here, right? And this is because government bonds are being printed at 13 and 14%. So tell me how we're going to get to single-digit mortgages. Right. So this is impacting every single sector. And so kudos to those of you on the funding side who are making debt facilities. But I agree, it's just a little too high to go to the DFIs. We need multiple layers of debt coming down the line to serve various sizes of organizations. And that's a great transition to regulation. I don't think you can do a fintech panel without mentioning regulation. So I'd love to turn to Omondi. Could you describe how does regulation, or maybe the lack thereof, affect your operations positively or negatively?
I think I'll start by prefacing that we like regulation. And we like regulation because of two things. One, it gives comfort to your customers that worst case scenario, they know who to run to. They can run to the central bank, they can run to the government. And on the basis of the fact that your customers have that comfort, it's then very easy to figure out how to build processes within the business that will make sure that the regulation is not an impediment for innovation. I think I'll preface it that way. Then if I look at regulation for what it is, most of the innovations that we're seeing today in multiple markets across Africa have been driven by regulation. We look at Nigeria. The instant payment network in Nigeria has been around for more than 15 years, even before some of the more developed markets. And that instant payment network has supported a lot of the fintechs that we see coming out of Nigeria. Because with a network in place, mandated by the government, the volatility or the velocity of cash is quite rapid. And that then creates a business model that fintechs can take advantage of. The other way to look at also regulation is some policies, such as the current one in Nigeria around cashless. The Nigerian government has been trying for a long time to shift the market from a physical cash type transaction into more cashless, because it's a costly affair for them, because they need to print notes every year, and they also need to build a lot of processes just to manage the KYC around movement of cash. So cashless makes sense for them. But if you look at it from the perspective of, say, businesses, you look at it from the perspective of fintechs, it's also something that makes sense. There's a cost to handling cash. As a business owner, if you receive all your payments in cash, at the end of the day, you need to think about the security of that cash, which means you either close early so that you go and deposit that cash in the bank, or you leave it there, but there's a risk that you can lose all the collections for a particular day. So I think that element where the government comes in to then force fit a cashless mandate will mean that the business will receive less of their collections in cash, because ultimately customers or consumers are the ones who will drive how you receive your payments. If all your customers are paying you in a digital manner, the problem around physical cash goes away. So regulations in some cases, or in a lot of cases, have actually been forward-looking. And in my mind, so long as the interaction between the regulator and the industry is one where the customer or the consumers are the ones who are king, it will always be something that is beneficial for both the industry players and the regulators.
Yeah, like I think this is a touchy one. A lot of entrepreneurs are like, ugh, rolly eyes. You know, I don't want to deal with all this regulatory policy, you know, when I'm just trying to keep my operations lean and I'm trying to test, right? So, I mean, I can vouch how long it takes to get payment licenses across the continent, and it's years, right? And sometimes you don't have years to open in a market. So, but at the same time, we can't ignore consumer protection. So anyways, I think it's a mixed bag. Okay, just a few more questions left between us and lunch, so hang tight, audience. Okay, nobody put their name down to this, but I have to ask this, and I'm gonna pick on you, Victor. So, ChatGPT is taking our world by storm. Every single industry, everyone's asking, like, is this gonna get rid of my job? Like, what is going on here? Or like, can I make my job easier? That's what I'm saying. We're thinking ChatGPT could be leveraged, right? It could improve, say, customer support. It could maybe help improve social media, you know, as you're doing your Facebook campaigns or Insta, which I'm not on. Like, so do you see Mastercard using, or are you guys already using AI or machine learning, any kind of ChatGPT chatter going on at Mastercard? What do you see as the future?
Yeah, great question. And I think, you know, I started by saying that we are a technology company. So when we see innovations, companies coming up with all manner of innovations, we take an interest. We take an interest because, you know, we have a responsibility to understand how that transforms the lives of, you know, the consumer. And obviously, if there's going to be a payment mechanism attached to that particular innovation, then obviously we would like to then work very closely with that particular partner. So when we look at, you know, ChatGPT, for us, we know it's new. We also know that it's exciting. We also know that it's AI-based technology that is helping to unlock some of the problems that we encounter on this, you know, in our world. And then when I relate it to what we do today, so as Mastercard, we actually do have AI solutions. And some of them, for example, in the risk-based segments, we've actually seen that it has improved the customer experience, specifically when they actually make payments or checkout processes, 13-fold increase in terms of customer satisfaction. And for us, satisfaction of our customers is very important because that's how you then drive scale, that's how you drive acceptance, that's how you start to actually get more and more people participating in a transaction, which fundamentally then addresses the area of financial inclusion and also addresses the underserved in this particular instance. But there are a couple of things that I also just want to latch on to as well. So one of them is to say, whenever you are actually driving payments, there needs to be a criteria around what do you consider as success. One of them is actually how does it become interoperable? Interoperable in the sense that it has to include everyone. That's inclusivity. Secondly, you also need to look at the convenience. So when I look at AI, it's addressing fundamental areas around how do we make the lives of the consumer better by understanding their behavior and the way they operate. And obviously as information is fed into this setup, it obviously will get better. And obviously as Mastercard, we are a keen party to this development. And ultimately, where the rubber meets the road is where you would then have to bring it to become a viable solution for everyone to participate as well. So this is aligned to obviously what we see as a future of payments. And as I think yesterday's presentation was around, we started more than 60 years ago, as a card company, more to the point. Now we are more than that. We are actually touching anything that is more than cards. We are actually going into remittances. We are actually going into, flows such as, virtual cards and so on and so on. So that is part of our DNA and something that we certainly look forward to and will be really, boosting how that actually works out.
Thanks for sharing. And look, as a technologist myself, I don't think technology solves for everything, but I am interested in scale. And the reason why this question came up in this section is because it can reduce costs. And so the more money that each of our companies can save in delivering whatever we're doing, then we can hopefully pass on that savings to the customer. But yeah, if, say, machine learning, like people complain that Bitcoin mining takes up a ton of energy, right? Like if AI or machine learning actually is costly still, then that's not a good thing. Okay, we're going to shift to revenue before we start wrapping up. So I think we can't forget this panel is about the unbanked and the underserved. But we're running companies, right? And so there's a lot of controversy around how we price our products and services because we want them to be financially inclusive. Therefore, we can't, charge up to the moon in luxury pricing. But yet we need to make sure that our businesses are sustainable. So Obi, I'd love to hear from you. What are your thoughts on banking pricing and how do you deal with that tension of needing products to be sustainable, or do you cross-subsidize? What's the pricing strategy?
Yeah, so I think it depends on what your end goal is. Obviously, financial inclusion is one of them, but as an organization, your bottom line is a bottom line, right? The more people we can reach, the larger the customer base, the larger the potential earnings that we can make. I'll give two examples. One is with Ecofi, the originally failed agricultural wallet program. Like I said before, one of the biggest challenges was the fact that generally in that space was that with telcos, there was a fee on every transaction up to 10%. And for these farmers that earned a small amount of money, $300 to $500 USD per annum, they can't afford to give up even a single dollar to anyone. So zero-based made a lot of sense. But of course, there are many other challenges. But one thing that we observed was the advantage of building an ecosystem. So you want to reach the Rwandan farmer, 4 million of them, we're the only partner that you can get to, right? We haven't quite achieved that vision, but that was the thinking. So we had a lot of success capturing, for instance, the largest coffee exporter in the country, the largest general agri-commodities trading company in the country, bringing them on board as borrowers for the bank just because we had the ambition of including farmers on a digital platform. And the interest income from a single one of those contracts is multiples of whatever we would have hoped to earn by taxing these farmers, right? So in the case of agriculture, it's a multi-sided market. Instead of trying to target the people with the least resource, you can perhaps bring them together as a collective and then use them to charge the people with the biggest amount of resource. And there's been a lot of success, and I think that success is going to inform some of our future strategies around that. On lending, we've all said capital is really expensive, right? For many of these instant loan schemes, mass market, the interest rates are huge, right? But it's the same thing in the US. Credit cards, that's where you find the biggest interest rates as well, right? I mean, up to 30% APR depending on who your provider is. In Africa, it's the same. And we actually come in below 30% APR. If you look at smartphone financing, on average, 25, 26%. You look at micro lending, on average, like 4% monthly, which undercuts many of the other players in the market doing 8 to 9%. And I think you have to look at the fact that people didn't have access to this before, right? But now if you need $500 in an emergency, you just open your phone, use the USSD platform, and you get the money immediately. Before, if you wanted to buy a $50 to $400 smartphone, you had to have the cash on hand. Now you don't have to, right? And now with MTN, we bundle data and airtime in one monthly payment that can come as low as $2 a month. And now that person has a smartphone, which allows them to create more value, right? So yeah, the cost is there, but there's also the value creation too that you cannot overlook, right? So it's a trade-off, and we shouldn't be afraid to charge.
I love that. I mean, I'm a social capitalist, so ultimately I'm probably more social impact led, but I mean, practically speaking, and this is something I'm grappling with now, running a family office, is what is grant appropriate, what is, impact investing appropriate, and where is debt appropriate. So just figuring out the right instrument of capital. So quickly, before our final question, Wayne, I'd love to hear on this exact topic, how do you think about what should be, you talked about impact investing. Where's grant capital more appropriate? Where's, equity appropriate? Where do you just need the debt facility at a reasonable rate? How have you as an entrepreneur approached the different instruments of capital?
Yeah, it's a fantastic question, and it speaks to the whole game that we're trying to play, the whole mission that we're trying to achieve, whether you're an investor or an entrepreneur or whatever. And I think I've been encouraged over the last 10 years at how the market has matured and developed. And I think it's really important that you know what you're asking for as an entrepreneur, and as an investor of whatever stamp, what you're putting your money into and why. And that might sound basic, but actually, basic's pretty good when you're navigating difficult things. So in simple terms, I think equity is what grows the bones, the skeleton, the muscle of your business. It grows your technology. It gets you to the machinery that can deliver. And I'm talking about credit here now specifically, but it could be sales of any description. Debt is what you need to be able to fuel that machine. So we take debt in order to provide debt, or we take credit in order to provide credit. I think there's a really important role for grant funding to move that needle and to take those risks which those other instruments either are not appropriate for or don't have the confidence to do. So, for example, we pay for and develop our own enterprise training syllabus. We do that all in-house. We could go to third-party providers, but they're very expensive, and so we're raising our cost base. So we work really, really hard to load as much value as we can into our customers' experience when they take a loan from us. But grant funding, and we've had a squidge in the past before, that actually allows companies like mine to go the extra mile, to do more to make the customer's experience better, to encourage the rest of the industry that actually debt and equity can follow where that grant has had a catalytic effect. The grant can take a number of formats. It doesn't just have to be pure money loaded into a balance sheet. It can be ring-fenced for specific projects. But I just want to give a shout out to debt guarantees, which is another way of kind of having a grant backstop to somebody else's risk capital, which gives them the comfort. So sorry if that's a bit Billy Basic, but actually those conversations need to be had.
No, I think that's great. I mean, guarantees are an important part. De-risk somebody up who's bigger up the food chain. So there's lots of roles to play. Okay, so now we're down to parting shots. We're going to just go down the line, and we've got a mixture of entrepreneurs in the audience. We've got some investors. We've got some ecosystem players. But if you could give one piece of advice to any players, so it could be the entrepreneurs, the investors, the ecosystem supporters, what would you say? And try to keep it brief.
Yeah, thank you. So I think from a Mastercard standpoint, we work with financial institutions, we work with governments, we also work with the digital economy, including fintechs, and we also work with the merchants. I think we are there to enable technology. Let's understand what it is that you need. If you have an idea in your head that you want to explore, we've got a team of Mastercard Labs technicians that actually help to unpack an idea that you have to be able to solve for the better good of the communities. So we are there to enable payments. Let's continue to drive the digital agenda. I think we've got a long way to go, but I think we're certainly on the right track and looking forward to really making the consumer's life even better.
Thank you.
I think on my own part, the parting shot is that this is just the beginning of a very long and probably profitable journey for people who create solutions that serve the market, because there's a very big gap in terms of either access, in terms of either properly designed solutions, in terms of either exits which then encourage a more robust entrepreneurial ecosystem. So it's just the beginning, but everyone has a part to play. From the investing side, understanding, yes, investing is a risk, but ultimately you're backing an entrepreneur who has even taken a bigger risk to try and come up with a new innovation. From the side of founders, a question about how do you build something that's big, impactful, and has not just impact on your own side, but also to the community. And I think ultimately for technology companies, I think technology is nothing new. Technology has always been there. 50 years ago, there was technology. 100 years ago, there was technology. Ultimately, technology is a way to solve problems that exist for the mass market.
I think the most important message now is maybe one of the hardest to deliver. And it's that we have an incredible future ahead of us. But businesses, investors, and government and regulators need to align on a growth agenda. We need to get out of our own way, and we need to unleash the power of business. That means progressive tax regimes. It means enabling regulation that protects the customers, but powers and encourages innovation, competition, and excellence. And if we try to kill the geese that lay the golden egg and tax the hell out of everything that moves, we are always going to be struggling, and people will be working harder to avoid paying tax than actually creating value that pays the tax in the first place. So let's breed more geese that lay golden eggs, let's get these economies moving, and let's make money for everybody, including the government.
Okay.
Well said.
I'd say for entrepreneurs in fintech, first of all, obviously this is very basic, but know your markets and know your users. You could build the best product ever, but if it's not adaptable to where you want to go or where you want to scale, there's no point. And I think in fintech, we're never ever reinventing anything. It exists already, you're just trying to make it better or provide another infrastructure. So really know who is using your products, from businesses to consumers, always. And for maybe investors is know your entrepreneurs and know that they're in the market and listen to them as well, because they would know what they're going through on a day-to-day basis.
I think for entrepreneurs, be creative about monetization. Digital finance space on the continent, it's big, and it's a multi-sided market. So many people that don't have access to these things who are potential customers for you, and many large players who have the resources who would be happy to pay for various services, value-added services that are born out of having that scale and having that ecosystem that you can build with your product. So be creative, lots of opportunity out there. No.
Absolutely.
Wonderful. Well, thank you so much for sticking around. Thank you so much to our amazing panelists, and have a great lunch.